Okay. Good morning, everyone. Good morning, dear students. I welcome you all to this second session on advanced capital budgeting decision. We have started a chapter in the previous session, and we have discussed few concepts for this chapter, and we're just going to continue with those discussions in today's session. What we have discussed so far is we have understood what is the impact of inflation on the capital budgeting decisions. So we have already discussed, what should be the impact of inflation, or how are we going to get inflation adjusted in our discussion for capital budgeting. And we have already said that simple golden rule that real cash flows needs to be discounted using real rate of return, and nominal cash flows needs to be discounted using nominal rate of return. So nominal rate of return is definitely going to be a bit higher than the real cash flows. Okay. And the real cash flows are the ones, the cash flows which are designed or defined using the current price level. Whereas nominal cash flows are the ones where the inflation impact is considered. Okay. So we just saw the relation between the real rate and the nominal rate. So 1 plus real rate is supposed to be multiplied with 1 plus inflation to get 1 plus nominal rate. So when I want to discount cash flows using nominal rate, which are essentially the nominal cash flows. So the nominal cash flow needs to be discounted at nominal rate. So for that, I'll have to use this particular formula. 1 plus real rate into 1 plus inflation is equal to 1 plus nominal rate. Okay. Then we did quite a few questions based on that. And one important takeaway from this was that, the tax effect on depreciation is not something which is getting affected by inflation. Okay. So inflation is not going to have any impact on the tax savings due to depreciation, because depreciation is a constant number. Okay. Then expected value, standard deviation, and coefficient of variation is what we did as one of the first tools for risk analysis. So we calculated the expected NPV, then deviation from the NPV, then we took the standard deviation. So these are like the numbers or the deviations which are telling us how much the variation or deviation is going to be there, how much the variation or deviation is going to be there when it comes to the expected NPVs, right? So expected cash flow, variance of cash flows, or standard deviation of cash flows using the cash flows and the probabilities. And if you wanted to calculate the expected NPV or variance of NPV or standard deviation of NPV, that can be calculated, of course, by using the NPV and their respective probabilities. Okay, then we did a few questions, and then we came up with a situation that suppose if we don't have different NPVs for different probabilities, but we do have cash flows. We do have cash flows for each of the year and their probabilities. Then we can calculate the variance of NPV as simply variance of first year cash flow divided by 1 plus R square. Then variance of second year cash flow divided by 1 plus R square, the whole square. Okay. So this is like the denominator needs to be in a squared form of your original counting factor. Okay, because variance is originally a squared form, and for that reason, we need to have this also in the form of the discounting, this also in that form. Okay. Now let us go for further discussion, wherein we are going to take the other set of concepts to discuss. Okay. So let's take up this question number question 16. Yeah. Yeah. Question number 16. The following are the estimates of net cash flows and probability of new project of Messrs. X limit. Probability of cash flows. So initial investment 4 lakh. Estimated net cash inflow after tax net cash inflow from year 1 to 5. It can be 1 lakh, 1 lakh 10 or 1 lakh 20,000. And estimated salvage value after tax in the 5th year, it's going to be 20,000, 50,000 or 60,000. Required rate of return from the project is 10%. Find the expected NPV of the project, best case and worst case NPV. Probability of occurrence of the worst case if the cash flows are perfectly dependent over time and independent over time. And standard deviation of coefficient of variation, assuming that there are only 3 streams of cash flows which are represented above, and then coefficient of variation. Okay. So let's first calculate the expected NPV. That expected NPV will be, of course, calculated on the basis of the probability and the cash flows. Okay. Let's try to get the expected NPV. So we have year, right? And then we are going to first say what is the expected cash flow. Okay. So year, expected cash flow. Then we'll take the PV factor and then we'll say present value. So in year 0, we are having a cash flow of minus 4 lakh. The cash flow is minus 4 lakh because that's the initial investment. Then in year 1 to 5, in year 1 to 5, the expected cash flow will be 1 lakh with a probability of 0.3, 1 lakh 10 with a probability of 0.5, and 1 lakh 20 with a probability of 0.2. So let's have these numbers. This is 1 lakh into 0.3 plus 1,10,000 into 0.5 plus 1,20,000 into 0.2. Yeah. So what is the expected cash flow over here? There should be 1,09,000. And then in the 5th year, the salvage expected cash flow is 20,000 into 0.3 plus 50,000 into 0.5 plus 60,000 into 0.2. So this is going to be how much? That's 43,000. Yes. So we have these cash flows. We can definitely write the PV factors. So present value factor is going to be 1. And for the other things, it's going to be discount rate is 10%. So with 10%, what's the PV factor for present value annuity factor for 3 years? That's 3.791. And the last year PV factor is 0.621. So let's multiply cash flow with PV. So this is minus 4 lakh, 1,09,000 into 3.791. That is 4,13,219. And then finally, this is 26,703. So take a total that will give us expected NPV of the project. Expected NPV. You just add them all and tell me what's the expected NPV. Yeah. You know what's the expected NPV? Expected NPV. Give me the value, guys. What's the expected NPV? Well, the expected NPV is what? 39,922. So this is the NPV that we are expecting, right? So Sai Kiran is asking, what is the purpose of variance standard deviation? Variance standard deviation project decision. Okay, variance or standard deviation is going to tell you, like for example, in our case is the NPV. This is something which is expected. It's not sure. So when you say that there is expected NPV for this value, right? So this is an expected NPV for this value. So it is subject to change. So how much can it increase or decrease? So that increase or decrease is captured by the expected by the variance or the standard deviation. Okay. So second case is calculate the best case and the worst case NPV. Now, how is this best case and worst case NPV computed? So best case NPV is like, everything is happening good, and worst case is, everything is happening bad. So we can get the best and the worst case NPV by simply looking at the best cash flows and the worst cash flows, right? So let us try to get the best case NPV. Or let me do one thing. We'll simply say E here, right? And then we'll talk of what is the best case cash. Okay. Best cash flow. And worst case cash flow. PV factor. Then we have best case PV and worst case PV. Okay. So here we have year 0. It's going to be minus 4 lakh. In fact, be it worst case or be it best case, cash flows are still 4 lakh. Then year 1 to 5, best case cash flow is 1,20,000, right? And worst case, the worst cash flow that's possible every year is 1 lakh. And then in year 5, best case cash flow gives you what? 60,000 inflow, and worst case cash flow gives you 20,000 cash flow. Okay. Present value factors, of course, 1, and then we have 3.791 and 0.621. So now we can get the best PV and the worst PV. So give me these numbers, guys. Give me the best case present value, I mean NPV, and the worst case NPV. Yeah, give me the final values. Give me the final values, guys. It's 4 lakh into 1 lakh 20 into 3.791, and 60,000 into 0.621. This 4 lakh needs to be subtracted. So just check and tell me what is this. Okay. Yeah, best case it is what? 90 to 180. Best case is 92,180, right? And worst case it is 8480, right? Okay. Then probability of case is the cash flows are perfectly dependent over time and independent over time. So these are the two situations now where we're talking of worst case possibility, right? So probability of occurrence of worst case if the cash flows are perfectly dependent or independent. Okay. Now, probability of worst case if dependent over time. If cash flows are dependent over time, then what's the probability of worst case? Now listen, this can be simply understood as so year 1, year 2, year 3, year 4, and year 5. So if I say that the cash flows are dependent, then you say cash flows are dependent. Okay, this one is negative. 8480 is negative, yes. They're saying that the cash flows are dependent. What interpretation do we draw out of it? We simply say that if the cash flows are dependent, if in 1 year you have a worst situation, if in one of the years you are having a worst situation, in all the subsequent years, the cash flows are going to be worst only. Because once it is worse, all other cash are going to be dependent, like, they're going to be worse. I mean, once it has come to the notice that the cash flows are of the worst situation, once it is known that the cash flows are the worst situation, then in year 2, year 3, year 4, year 5, every time it is worse. It's sure that the cash flows are going to be worse for the next 4 years. So that is simply like going to be here the worst situation possibility is 0.3. Worst situation possibility is what? Probability is 0.3. So in year 2, what will be the probability of worst situation now? So in first year, the probability of worst situation is 0.3. In the second year, when you say that the second year is dependent on first year, what will be the probability of worst situation? If in the second year, we say or second year is dependent on the first year, what will be the probability of worst situation? Well, the probability is going to be 1, guys. The probability is going to be 1 because once it has happened that the worst situation has come to the forefront, once it has happened that there is a worst situation happening, even in the second year, third year, fourth year, it is going to be surely worse. There is no way of having any other value. There's no way of having any other value. So once, and this is applicable in case of dependent situation. So in case of dependent situation, if in the first year you have a worst situation, the second, third, fourth, fifth, each of the years is going to be in the worst situation only. And therefore, the answer to this is going to be 0.3. Now, when we look at what will be the probability of worst case if cash flows are independent. Probability of worst case if cash flows are independent. So we have year 1, year 2, year 3, year 4, and year 5. So if it is independent, we say fine, in the first year you have a chance of getting the worst situation as 0.3. Now, second year is not dependent on the first year. So second year, again, you can think of having the worst situation with the probability of 0.3. Third year is again not dependent on the second year. So you can say there's a probability of 0.3. So in each of the years, you have a chance of 0.3 being in the dependent situation. So being independent, in each of the years, you have 0.3 chance. Right? In each of the years, they're having 0.3 chance, right? Or 30% chance of being in the worst situation. So let's just multiply all of them. And that will give us the probability of cash flow being worst throughout the project in independent situation. So the answer will be what? 0.00243. Okay, so if it is dependent, if the cash flows are dependent over time, then the first year will be 0.3 and subsequent years the probability is 1. And if it's the worst case independent, if the cash flows are independent, then every year there's going to be a possibility of 0.3. Every year there's going to be a possibility of 0.3. Okay. Now, let's look at the next case. Then standard deviation and coefficient of variation, assuming that there are only 3 streams of cash flows, which are represented by each column of the table with the given probabilities. So you want to calculate the standard deviation, right? Standard deviation and coefficient of variation, assuming there are only 3 streams of cash flows. There are only 3 streams of cash flow which are represented by each column of the table with the given probabilities. Okay. So now what will be the standard deviation and coefficient of variation for this? Standard deviation and coefficient of variation. standard deviation and coefficient, assuming there are only three streams of cash flows which are represented by each column with the given probabilities. So if I want to get the standard deviation and coefficient of variation, then the fifth part is coefficient of variation on an average project which is in the range of 0.5:1. If the coefficient of variation is found less risky than average, 100 basis points are deducted from the company's cost of capital. Okay, so first we need to get the standard deviation and the coefficient of variation. So let's try to calculate the standard deviation and the coefficient of variation. So let's say we have the probabilities given to us. Okay, for a given probability, we have the cash flows. So probability is what? 0.3, 0.5, and 0.2. Okay, and then we have for 0.3, 0.5, 0.2, there are three streams of cash flows. We need to get the expected NPV, or C. We have to get first the NPV. So 0.3 chance that your NPV is going to be what? 1 lakh into present value annuity factor, which is 3.791 minus 4 lakh being the initial investment plus 20,000. So let me just add plus 20,000 into 0.621 minus 4 lakh. Yeah. So what is this? 1 lakh into 3.791 plus 20,000. So 1 lakh into 0.621. Sorry. 1 lakh into 3.791. Or 1 second. We are saying that the question is coefficient of variation on its average project. Standard deviation coefficient, assuming that there are only three streams of cash flows which are represented by each column in the table with the given probabilities. So there are three streams of cash flows, 1 lakh, 1 lakh 10, and 1 lakh 20 with their respective probabilities. Standard deviation of this. Okay, so NPV. Over here, we have the NPV number 1 lakh into 3.791, which is 37, 3,79,100. One second. No, it's not like this because the question says coefficient of variation, sorry, standard deviation coefficient of variation, assuming that there are only three streams of cash flows which are represented by each column of the table with the given probabilities. So there are only three streams of cash flows, which is one for each of this. So we'll talk of like every year we have three possibilities of cash flows, which is 1 lakh, 1,10,000, and 1,20,000. 1 lakh, 1,10,000, and 1,20,000. So now what will be the 1 lakh, 1,10,000, 1,20,000? So I need to first get the expected cash flow, right? So we are not saying we want the standard deviation coefficient of the project. We want the standard deviation coefficient of variation of the cash flow. So we have expected cash flow, and based on expected cash flow, then we'll also talk of the standard deviation. So first, for the expected cash flow, we multiply probability with cash flow. That will give us the expected cash flow. And then we have like cash flow minus expected cash flow. Then it's going to be cash flow minus expected cash flow square multiplied by probability. Okay, so just give me the expected cash flow number, guys. Just give me this expected cash flow number. That should be totaling to what? This will be 30,000. This is 55,000. And this is what? 24,000. So just add them all. Just add them all. 30,000 plus 55,000 plus 24,000. So this is what? 1,09,000. 1,09,000. Then you just get the, expected cash flow is 1,09,000. With this expected cash flow, try to get with this expected cash flow, just try to get this and then the standard deviation. Try to get this with the standard deviation of the cash flow is. Yeah, guys. So subtract this 1,09,000 from each of them. So this will be what? 1 lakh minus 1,09,000. There will be negative 9,000. 1,10,000 minus 1,09,000. Positive 1,000. And this is 11,000. Just take the square of it, multiply it with the probability, and take the total. So that's 9,000 into 9,000, and then multiply it with 0.3. That's 243 lakhs. Then there is 1,000 into 1,000 into 0.5, which is 5 lakh. 11,000 into 11,000 into 0.2, which is 242 lakhs. Okay, then just add it. 243 plus 5 lakh plus 242. This is what? 49 lakhs. So the standard deviation is square root of 49 lakhs. The square root of, it's what? 490 lakhs. Okay, yeah, correct. It is 490 lakhs. So standard deviation is 7,000. And what will be the coefficient of variation? Coefficient of variation. Coefficient of variation is standard deviation upon expected value of 1,09,000. So 7,000 divided by 1,09,000, that is just 6.42%. Right? Standard deviation divided by the expected cash flow. Okay. In calculation NPV of best case and worst case, we not use the probability. No, we didn't use the probability because we anyways wanted to get what will happen if the best case is happening. So like 90 to 180 is having the probability of best case, which is 0.2. So there we wanted the NPV, assuming that it is best case. There is no probability attached to that then. Here we are looking at the entire project. Okay. So the coefficient of variation is now 6.43. So should the project be accepted? Because they're saying if the coefficient of variation of project is found less risky than average, 100 basis points are deducted from the company's cost of capital. So our cost of capital originally was at 10%. And as we said, since the coefficient of variation is less than 0.95, therefore revised discount rate is what? Rate of return is 10%. So out of 10%, you're going to subtract 1%, which is 9%. So revised discount rate is 9%. 10% minus 1%, which is turning out to be 9%. Okay. 5-year present value annuity factor is 3.89 or 3.79. Okay, so this is what, 3.89. This is 3.89. But I think, yeah, these final numbers are correct. Okay, the revised discount rate is 9%. And based on this revised discount rate, we need to get the revised NPV. So revised NPV, or what it is. No, this was correct, right? So this is correct, 3.79. And in fact, this is also correct, 3.79. The new revised thing is going to be there, right? Yeah. So revised NPV, for the purpose of getting the revised NPV, we take the year, the respective cash flow, present value factor at 9%, and then you have the PV. So year 0, 1, 2, 5, and 5. So in year 0, you have negative cash flow of 4 lakh. 1 to 5, it is 1,09,000. And fifth year, 43,000. So present value factor at 9% is 1, and this is 3.8897, 0.6499. So just give me the NPV. Give the final NPV is, or the revised NPV, I can say. So 51,000. So revised NPV is what? 51,923. Or something here and then, somewhat, because of rounding off effect. Okay, fine. So that completes this question, guys. So let us go for the next concept, rather. So let us discuss two concepts together now. So the two concepts together that we are going to look at, something called as certainty equivalent, and we are having two concepts that we are going to do it together. One is a certainty equivalent, and other is risk adjusted discount rate. Okay, certainty equivalent and risk adjusted discount rate. Now for that, let's try to understand. Let's say we have a project with its cash flows like this, or this is your expected cash flows, I can say. So in 0, 1, 2, 3, 4, 5. So let's say we have a 5-year project. Expected cash flows are like, let's say you're going to invest 100 and you're going to get 25, 60, 75, 80, and 65. So this is the value of expected cash. Now, when you say these numbers as expected cash flow, what does this mean? Is it meaning that you have this cash flow with surety? You're going to have these cash flows with surety? Yeah. Do you think that these cash flows, expected cash flow, these cash flows are the cash flows with 100% surety, or it is subject to some sort of fluctuation? Is it subject to some sort of fluctuation or not? Of course, yes, because the name itself is expected cash flow. And the actual cash flow may definitely vary from expected cash flow. So these expected cash flows are something, which are subject to fluctuation. But now if I tell you that we can attach a certainty equivalent with this, right? So we are going to attach, let's say, a certainty equivalent factor to this. Certainty equivalent factor. They are simply going to tell you the proportion of cash flow which is certain. So certainty equivalent factor is proportion of cash flow is certain. So certainty equivalent factor simply means the proportion of cash flows which is certain or which is surely going to rise. So certainty equivalent factor, which means the proportion of cash flow which is certain or which is sure. So let us say I am attaching a certainty equivalent factor. Of course, the initial year certainty equivalent is 1. First year certainty equivalent is 0.9. Second year certainty equivalent is 0.8. Third year certainty equivalent is 0.7. Fourth year certainty equivalent is 0.6. And fifth year certainty equivalent is 0.5. So this means 90% of the expected cash flow surely going to have. 80% of the second year cash flow, you're going to surely going to have. 70% of this expected cash flow is going to be surely coming to you. So when we have this sort of situation where the cash flows can be actually, tracked down with certainty how much is sure. So we'll simply calculate certain cash flows. So certain cash flows are minus 100, 25 into 0.9, which is 22.5, 60 into 0.8, which is 48, 75 into 0.7, which is 52.5, 80 into 0.6, which is 48, 65 into 0.5, which is 32.5, right? So these are certain cash flows. These are your sure cash flows, right? These are the certain cash flows or sure cash flows. Now, there is no subject, there is no safety or risk in this. So what rate should I use to discount these certain cash flows? What rate should I use? what rate should I use to discount these cash flows? Should I use the cost of capital to discount these cash flows, or should I use a risk-free rate to discount these cash flows? Should I use a risk-free rate, or should I use a cost of capital to discount? Yeah. Yeah. What should be the cash flow? What should be the rate that I should use? My cost of capital to discount these cash flows, or should I use a risk-free rate? Of course, I need to discount using risk-free rate. So we'll take the present value factor at 5%, which is the risk-free rate, and then you take NPV. So when you have converted your normal cash flows to certain cash flows by multiplying it with certainty equivalent. So when you have converted your normal cash flows to certain cash flows by multiplying it certainty equivalent, then obviously the summation of all PVs or present values is going to be your NPV. Right? And this is going to be discounted using risk-free rate. But what if I want to discount these cash flows? Yeah, tell me. So we just made a rule that certain cash flows should be discounted at risk-free rate. Okay. Certain cash flows should be discounted at risk-free rate. So certain cash flows should be discounted at risk-free rate. And if I say, apart from this, certain cash flows discounted risk-free rate, we can definitely say expected cash flows, which are, of course, the risky cash flows. They should be discounted at risk-adjusted discount rate. They should be discounted at risk-adjusted discount rate. Now, what is this risk-adjusted discount rate? The risk premium. So risk-adjusted discount rate is the risk-free rate plus the risk premium. Risk-adjusted discount rate is risk-free rate plus the risk premium. Risk-adjusted discount rate should be risk-free rate plus the risk premium. Okay, so risk-adjusted discount rate needs to be calculated like this. Now, of course, the risk premium that we have, the risk premium, that is going to be affected by what? How are you going to determine the risk premium? Of course, the risk premium depends on risk. So higher the risk, higher will be the the risk premium that we are attaching. So when you say risk premium or risk adjusted discount rate, you can say it's going to be risk free plus risk premium. So risk premium depends on the risk. Risk premium depends on the risk. With another type of risk analysis called as sensitivity analysis. Okay, so let's talk about something called as sensitivity analysis. Okay, one second, one second. Before the sensitivity analysis, let me complete this. As we had this number, these are the expected cash flows, right? So these were expected cash flows. We discounted the sure portion with the risk-free rate. Now, risk-adjusted discount rate will be what? Risk-free rate. Risk-free rate, let's say, which is, what was the risk rate? 5%. Plus, you attach a risk premium to that, let's say 7%. Now, how is this 7% determined? That we will be essentially dealing in the chapter of portfolio management. So when we will be starting with the chapter of portfolio management, that time we'll be dealing with this 7%. So risk-free rate is 5%. Plus we want a risk premium of 7%. So risk-free rate 5% plus a risk premium of 7%. So that gives you the risk-adjusted discount rate to be 12%. So you discount your cash flows using risk-adjusted discount rate. Right. So higher risk, if the project is having a greater degree of risk, you will obviously attach a higher risk premium to it. Right now, we have just assumed it to be 7%. Okay. So you just need to discount the cash flows using this 7% to arrive at the risk adjusted discount rate NPV. Okay. Fine. So that is your certainty equivalent and risk adjusted discount rate. So the simple idea is certain cash flows, sure cash flows needs to be discounted using risk-free rate. Risky cash flows, uncertain cash flows needs to be discounted using risk-adjusted discount rate. Now, risk-adjusted discount rate is, of course, the discount rate that's going to be calculated by adding risk premium to risk-free rate. By adding risk premium to risk-free rate. Okay. Now, let's go for the next topic to discuss. Again, which is going to be an interesting topic, and that is sensitivity analysis, guys. So we have to calculate or we have to do something called as sensitivity analysis. Now, understand, in any capital project, there are multiple inputs that are taken and the output is the NPV. So in sensitivity analysis, we first identify which are the input variables. Which are the input variables. And then we also identify what is our output. So in capital budgeting decision, we know that our output is NPV. Our output is NPV. So what will be the input variables which will be used to calculate NPV? What will be the input variables? Tell me. So what numbers you should know so that you can calculate the net present value of a project? What numbers you should be knowing so that you can calculate the net present value of a project? Yeah. What should be the input? What should be the input, guys? Input variable can be like, okay, perfect. Ravinder, it's investment unit sale value per unit variable cost. Perfect. So input variables will be like, what is your initial investment? Right, initial investment, units that are going to be sold, sale price per unit, variable cost per unit, let's say fixed cost per annum, right? And let's say discount rate. So initial investment, let's say initial investment is 400. Units sold is 5 crores. Selling price is 100 per unit. Let's say variable cost is 50 per unit and fixed cost per annum is, let's say, 50 crores. And suppose the discount rate is 6%. Now, of course, taking all these inputs, we can get the NPV, right? Taking all these inputs, we can get the NPV. Okay. So let us first calculate the base case NPV. Base case NPV. The base case NPV means NPV calculated looking at the individual cash flows that we have. Okay. Now, the base case NPV can be calculated by, of course, first you need to calculate the cash flow. So we can get the base case NPV by first looking at cash flow per year. Now, what will be the cash flow for per year? It's obviously 100 selling price minus variable cost 50 multiplied by 5 crore units minus 50 crores of fixed cost, right? That will give you the cash flow per year. So tell me, what's the cash flow amount per year? Cash flow per year is what? 200 crores. Okay, so 200 crores is the cash flow per year. Now, with this cash flows, we can definitely get the NPV as 200 into present value annuity factor at 6% for, let's say, let us assume it to be 3 years to make the things easier. So 200 into present value annuity factor at 6% for 3 years. Okay, let's say term of our investment is 3 years. So this is your inflow minus an investment of 400. Okay, so what is the base case NPV, guys? This will be 200 into 2.673 minus 400. So what is the base case NPV? Base case NPV is what? 134.6. Okay, so this is the base case NPV. Now we want to calculate like NPV for some small changes in these variables, right? So when we say sensitivity analysis, we want to see what is the impact. We want to really see what is the impact of adverse changes in these variables on NPV. Adverse change in this variable on NPV. So we want to know what is the likely impact of adverse changes in these input variables on the output variables, which is NPV. Okay, so let us see what is the impact of each of these adverse changes. Okay, so we have to revise the what do you say, NPV, or recalculate the NPV figures, and then we'll check for the sensitivity numbers. So let's prepare a format properly, or let's have a proper table for this. So in the initial case, we say initial cost increase by 2.5%, sale price per unit decrease by 2.5%, variable cost per unit increase by, let's say, 2.5%. So let us assume 2.5% adverse variation or adverse change in each one of them. Let's say fixed cost per annum increase by 2.5%, and units sold, let's say, reduced by 2.5%. Okay, so for each of these situations, we'll say what are the units, sale price per unit, variable cost per unit. Okay, then you'll have something like contribution per unit, and then you'll say total contribution, then you have fixed cost per annum, and then net cash flow per annum. Okay, so initial cost, then we'll say initial investment also. Okay, and based on this, we are definitely going to calculate the NPV. So NPV will be calculated as net cash flow per annum multiplied by 6%. So 6% annuity factor is 2.673. Net cash flow per annum into 2.673 minus initial investment. Okay. So when your initial cost increase by 2.5%, all other factors are going to remain same. Like your units is still 5 crores, sale price is still 100, variable cost is 50. So contribution will be 50. Right? So contribution is going to be 50. Then total contribution will be 250. Fixed cost is 50. So the net cash flow per annum is 200. Initial investment, as we said, initial cost is increasing by 2.5%. So initial investment, which was 400, that will increase by 2.5%. So the initial investment becomes 410. So now the NPV calculation, we can do it. 200 into 2.673 minus 410. So what is the NPV in the first year? I mean, in the first case, that will be 200 into 2.673 minus 410. So 200 into 2.673 minus 410. This gives us the NPV number as 124.6. NPV is 124.6. Now, we have to same way calculate NPV for all these 4 situations. We have to calculate NPV for all these 4 situations, but there is going to be change in only few of the factors, not all of them. Right? So initial investment in all other cases will continue to be 400, right? And then the changes that are going to happen. First, selling price decrease by 2.5%. So this will become like 97.5. Rest all numbers will remain same. Variable cost per unit increase by 2.5%. So this will be 51.25. Fixed cost is changing by 2.5%. So this is also like 51.25. And units sold are reduced by 2.5%. So 5 into 97.5%, which is, so units will be 4.875. 4.875. Okay. So now, based on this, rest all numbers are going to remain same. As I said, only these numbers are going to be the changing numbers. Rest all numbers are going to remain same. There's no change in it. Right. So based on this, I want you to calculate these four NPVs, guys. Get the four NPVs. Get the four NPVs. So I'll just write down the numbers. Let's say units will continue to be 5 over here. Sale price will continue to be 100. Variable cost will be 50 in all other cases. Contribution is, of course, you can calculate it. Total contribution also calculated. Fixed cost will continue to be 50 in other cases. So now just you need to compute the contribution to per unit, total contribution, net cash flow, and then these four NPV figures. Get the NPV figures, guys. Get the NPV, guys. Okay, 124.6. Change in selling price per unit NPV is, which is the second case, right? So there the NPV is what? 101.18. Okay. So we get this as 101.18. Perfect. Variable cost per unit NPV is 117.89. Okay. Then the fourth case and the fifth case. Change in fixed cost NPV is what? 131.26. And the last case, units sold getting reduced by 2.5%. Okay. The last case is what? 117.89. Okay. Now let us measure what is the percentage change in NPV. So originally the NPV was 134.6 and now it is 124.6. So 124.6 minus 134.6 divided by 134.6. So what is the percentage change in NPV? So original NPV was 134.6 and this new NPV is 124.6. So 124.6 minus 134.6 divided by 134.6. 124.6 minus 134.6 minus 10 divided by 134.6, which is what? 7.43. So minus 7.43. Minus 7.43. Second case, it is 101.8 minus 134.6 divided by 134.6. 101.8 minus 134.6 divided by 134.6. 24.37%. Right? So it's 101.18. Sorry. So 101.18 minus 134.6. This is divided by 134.6, which is 24.83. Okay. Same way, what are the percentages in other three numbers, guys? Other three cases. So the percentage changes are, this is minus 12.41%. The next case, it is minus 2.48%. And last is minus 12.41%. Okay. So now, what was the percentage change in input? In each of this situation, we said that the percentage change in input was 2.5%. So everywhere we just took a 2.5% change in the input. So in each of the situation, the percentage change in input was 2.5%. So each of these situation, percentage change in input is 2.5%. Then we will talk of what is the sensitivity. Okay, 7.43 divided by 2.5, which is 2.972. 2.972. That's the sensitivity minus 2.972. Here it is minus 9.93. Here it is minus 4.96, minus 0.99, and minus 4.96. So what does this indicate? Sensitivity is simply for 1% change in input, what percentage change will happen in NPV. So this is what the numbers we get. So now, of course, out of these sensitivity numbers, can you tell me which factor is most sensitive, or which factor is going to have a greater influence? Out of these sensitivity numbers, can you tell me which factor is having a greatest degree of sensitivity? Which factor is having the greatest degree of sensitivity? Of course, it is minus 9.93, which is sales, right? So we can say NPV is most sensitive to changes in selling price per unit. So NPV is most sensitive to changes in selling price. So what is the whole purpose of doing this exercise? Why do we need to do this sensitivity analysis? For a simple reason, guys, because we want to obviously ensure that this sensitivity is taken care of, right? We want to be sure that which variable needs to be controlled in the best possible way. Because if I don't control the selling price properly, I can see for 1% change in the sale price, my NPV will drop by 9.93%. It's a huge number. So I need to have a proper control over this particular input, which is your selling price. The selling price needs to be controlled so that there is no adverse impact on the NPV. Okay. Fine. Okay. So yeah, with that, we're able to identify which of these factors is most sensitive to changes in the selling prices. So NPV, as we said, is going to be most sensitive to the selling price. We need to have a proper control over it. Okay, now let us go for understanding another case which is similar to this situation. I mean, it's not similar, but some sort of similarity with what we have discussed when it comes to sensitivity. So we're now looking at another analysis called as scenario analysis. So scenario analysis means we are going to calculate NPV. We are going to calculate NPV under different scenarios. So you're going to calculate NPV under different scenarios. Right, so we're going to calculate NPV under different scenarios. So when it comes to scenario analysis, we're going to do NPV under different scenarios. Okay. So NPV under different scenarios means we are going to obviously have multiple scenarios. So let us say we have three possible situations. Like it could be a worst case scenario. It could be a most likely scenario and a best case scenario. Okay. So let's say in year 0, 1, 2, 3, for each of these years, we are definitely going to have the cash flows. And of course, we can get the present value. So cash flows and the present value, cash flows and the present value. Right. So let us take present value factor at 9%. So it is 1, 0.917, 0.842, and 0.772. So these are your present value factors. Now, worst case, most likely, and the best case scenario. So I'm just saying that if it's a worst situation, of course, you're going to make an investment of, let's say, 1400. So whatever be the situation, you're going to have the cash outflow as 1400. And then first, second, and third year cash flows. We have 450, let's say, 400, and 700. So these are the cash flows possible when we have the worst situation. In case of a mediocre or a most likely situation, we may have the cash flows as 550, 450, and 800. And in the best case situation, first year you may get a cash inflow of 650, then 500, and then finally 9. So can we get the NPVs in worst situation, in the most likely situation, and in the best situation? So if let's say worst situation is faced by the entity in all the 3 years, then what's the NPV? If the most likely situation is faced by NPV, then by the entity, what will be the NPV? And if in the all years you're having the best case or the best things possible, then what's the best possible NPV? We can calculate these NPVs. Calculate these NPVs, guys. Calculate the NPVs. So in the worst situation, NPV is what? Minus 110, minus 110.15. In the most likely situation, it is what? 100.85. And in the best situation, what's the NPV? Okay, that's 311.85. 311.85. Now, if I ask you, if it's most likely situation, let's say in year 1 and 2, we are anticipating the most likely situation. And in third year, we are anticipating worst case in year 3. Most likely situation is in year 1 and 2. And the worst situation is in year 3. Most likely situation is in year 1 and 2. and worst situation is in, let's say, year 3. Then what is the possible present value and NPVs? Yeah, so it's like if most likely is in year 1 and 2, you can see in 0th year 1400 is a sure outflow. And then in the first and second year, you'll say is going to be what, 550 and 450. And in the last year, you will say 700. So just to take the present value. So this present value comes out to be what? 23.65. So you can just toggle between, we just keep on toggling between, multiple types of uh, possibilities, right? So you can just keep on toggling or keep on shifting between multiple types of uh, decisions. Like if we say worst situation, then what's the NPV? If you say first year, it is going to be the best, and then it is most likely, and then it is worst. You can obviously have that combinations available with you. Okay, fine. So that is about something called as scenario analysis. So in this scenario analysis, we are going to simply say these aspects, which is multiple scenarios or different scenarios with different NPV outcomes. Okay, fine. So that is about scenario analysis. Okay, so after that, let's just take a break right now, guys. Okay, and after the break, we'll be discussing about the replacement decisions. Okay, we'll discuss about the replacement decisions, and then we'll take the discussion forward because we have still to do with what decision tree, replacement decisions, and other such things to do. Okay, so let's take a break right now, break of around 15 minutes, and then we'll come back and discuss about the replacement decisions, one of the important techniques when it comes to your capital budgeting. Okay, so let's take a break now, guys. Okay, welcome back, guys. I hope you are all there. Okay, so now let us continue for the next point of discussion, which is about the replacement decisions. Okay, so let's talk about replacement decision problems. Now we know that machineries or any depreciable asset for that case needs to be replaced at regular intervals, right? So these machineries or the other depreciable asset needs to be replaced. But then there are few questions that we need to answer. Replacement decisions can be with regards to two point of view. So replacement decisions can be, first you need to decide, the first point of view of replacement decisions which we can say is decide whether to replace an old equipment with a new one or not. Replace whether decide whether to replace an old equipment with new one. That is one question that we may have. And the second question which we may need to answer is decide when to replace. So you decide when to replace an old equipment or when to replace an equipment. Or we are essentially trying to understand or trying to calculate what is the replacement cycle for that case, right? So what is the time period or the regular cycle of time period within which we should be replacing the older ones and obviously bringing in the new ones. So these are the two aspects that we are going to consider, out of which, the first one is a typical capital budgeting problem. There is no other concept that's going to be involved in it. Okay, so there's no other concept that will be involved in analyzing the first question, which is whether to replace. So we just need to look at like whether the NPV is positive or not. So if the NPV is positive, we are going to replace it. If the NPV is negative, we are not going to replace it. As simple as that. So let's try to understand with this, with an example for this. Let's say okay, suppose we are evaluating a replacement, right? So first and foremost, as I said, we need to get the NPV. Now, for getting the NPV, we of course need the information about the cash flows. So first thing that we need to get is incremental cash inflows from the new system. Okay, so first thing that we need to calculate is what is the amount of incremental cash inflows. What is the amount of incremental cash inflows per annum from the new system or new equipment or whatever you say. So from the new equipment, what will be the incremental cash flow? Of course, the incremental cash flow from the new equipment will be calculated by simply taking what is the incremental sales from that, right? So we need to have an idea what is the amount of incremental or extra sales that we'll be able to generate, plus any incremental savings. Plus any incremental savings. Now that incremental savings will be simply comprising like any manual labor saved or any other expense which is going to be which was supposed to be incurred. Now after new equipment, it will not be incurred. So all those aspects are taken care. And then we are going to, of course, subtract any incremental expenses minus any incremental expenses which we are going to have. And after this, the hidden part is add back any tax savings on incremental depreciation. Now, of course, since we're going to get a new machine or a new equipment, that new machine or new equipment is going to have a higher value. And due to that, you can definitely claim additional or incremental depreciation. So that tax savings on incremental depreciation also needs to be calculated when we are calculating the incremental cash flow per annum from the new system. Okay. So let us say I think we have one question. Just wait. Okay, wait. We'll just take an example for this. Suppose they are looking for replacing an old equipment, and first we calculate what is the incremental sales. So we need to look at what will be the increase in the sale value. Okay. So with the increase in the sale value, we'll be able to get a higher sale, which will be contributing to our cash flows, right? So suppose if you're looking at incremental sales, let's assume incremental sales is like your originally it was 1 lakh, right? So your original sales was 1 lakh, and we are saying that the sales is going to increase by 10%. So if your sales is going to increase by 10%, I can say the incremental sales that we have is 10,000 rupees. Less if you're subtracting any incremental savings. Are we going to save anything? So I say yes, we are going to save certain expenses, which is let's say 5,000. And are we going to have any, or rather it will be added, sorry, to add any incremental savings and subtract, we're going to subtract any incremental expense which we are going to incur. So let's say since we're going to replace the identical machine maybe, so there's no incremental expense. Now, of course, this extra cash flow of 15,000 which we are having, right? This extra cash flow of 50,000 that we are having, this is total cash flow before depreciation impact, right? Before depreciation impact. So now, of course, I can convert this 15,000 to after tax cash flow. So this will be like after tax cash flow before depreciation impact, which is 10,500. So assuming that tax rate is, let's say 30%, assuming tax rate is 30%, we can say after tax cash flow before depreciation impact is 10,500. Okay. Now, then we have from this 10,500, we can get the tax savings from any sort of incremental depreciation. So how do we get the incremental depreciation? So let's understand this way. Old equipment was giving us a depreciation per annum. Old equipment was entitling us to get a depreciation per annum of 2,500. Now, the new equipment depreciation per annum is 9,800. Then we take the difference, and this is like incremental depreciation per annum. So we say with the new equipment, we will be able to generate, or we will be able to claim additional depreciation of 7,300. With the new equipment, I'll be able to claim an additional depreciation of 7,300. And then we have tax savings. So tax savings is 7,300 into 30%, which is 2,190. So tax savings is going to be 2,190, right? So we are going to save this 2,190. So now if I ask you, what is the net incremental cash flow per annum from new equipment? So with this new equipment, we are having after-tax cash flow as 10,500. To that you add 2,190. So total is 12,690. So total it is going to be 12,690. So net incremental cash flow per annum from the new equipment is 12,690. Okay, net incremental cash flow per annum from the new equipment is 12,690. Okay, so that's going to be a like net incremental cash flow per annum from a new equipment. You have 12,690. So once we have determined that this is going to be the what is it, 12,690 is a net incremental cash flow. Now we can simply go ahead and think about calculating the NPV. Right. So now, of course, in the initial NPV, I need to have in the initial for the initial year, I need to look at what cash flows are we going to have, right? So the cash flows from this new NPV is essentially going to be what the cash flow from this new NPV or from the new system, from the new equipment. It is going to be the purchase of the new equipment. Obviously, old equipment will be sold, and then we also need to look at the tax savings on the loss of old equipment. Okay, so let's say cost of new equipment. So cost of a new equipment is, let's say, 50,000. Okay, and I say cost of old equipment. Cost of old equipment is, let's say, it was, let's say, 25,000, which was 5 years ago. Okay, so depreciation till now that has been claimed is, let's say, depreciation, old equipment we were charging 2,500. So till now, 2,500 into 5, which is 12,500, is the depreciation that has been claimed. So we can get the WDV, which is 12,500. WDV is 12,500, right? We are going to sell this particular equipment for, let's say, 5,000. We are going to sell this particular equipment for a value of 5,000. And then we say, what is the loss on sale? Loss on sale is 7,500, because the equipment which is having a WDV of 12,500, we are selling it for 5,000. It means surely we are making a loss on sale of 7,500. And then we simply say, what is the amount of tax savings from this loss? So we'll say 7,500 into 30% maybe. So 2,250. This is the tax savings that we get from the loss that we are incurring when we are selling the old equipment. So I need to subtract from the cost of new equipment. First of my cost is going to be reduced by sale of old equipment. So when I'm selling the old equipment, I'm going to sell it for, let's say, 5,000. And also I will be saving tax, savings in tax. So the tax that we are going to save is 2250, right? And then finally we say this is the net cash outflow in a year. Net cash outflow in a year. So we say the net cash outflow will be 42,750. So net cash outflow in a year is 42,750. Okay, so net cash outflow in a year is supposed to be 42,750 after account in a year, in the first year or in the 0th year, I can say. So initially you need to make an investment of 50,000 for purchasing the new machine. But wait, we are also going to save on these cash flows. So these are like cash inflows for us. So that is essentially your 42,750, which is the net cash outflow in the year. Okay. So now, once we know that this is going to be our cash flow in the 0th year, this is going to be our cash flow in the 0th year, we can simply calculate the NPV now. Right. So NPV calculation will be what? You'll write down the year, cash flow, PV factor, and then PV. So in year 0, you're putting in 42,750 in the net form. Then from year 1 to 5, the cash flow is 12,690. And in the 5th year, let us say the salvage value is 1,000. So now you can simply take the NPV. And as a rule, if this NPV is positive, we will simply accept the project. And if this NPV is negative, then we are going to reject the project, or we are not going to go ahead with the replacement. Okay. I hope this makes sense to all of us. Right? Let us say let's look at this question number 23, guys. Let's try to solve this question number 23 and few others. Let's look at this question number 23. Yeah. So a company is having an old machine which is having a book value 0. So of course, when we are selling it for something, there will be a profit on sale because they're saying book value 0, but we'll be able to sell it for 50,000. The company is thinking to choose one of the following two alternatives. First is to incur additional cost of 10 lakh to upgrade the old existing machine. To incur an additional cost of 10 lakh to upgrade the old existing machine. And second is to replace old machine with a new machine costing 20 lakh plus installation cost 50,000. Both above proposals envisage useful life to be 5 years with salvage value to be nil. The expected after-tax profits for the above three alternatives are as under. So expected after-tax, these are the after-tax profits we have from the above three alternatives. So if you have the old existing machine, what is the after-tax profit that given to us? Upgraded machine and the new machine. And the tax rate is 40%. The company follows a straight line method of depreciation, guys. Okay. So straight line method of depreciation needs to be computed, and we have to choose like whether we should continue with the old machine, or we should go for a new machine, or we should simply go ahead and upgrade the machine. Okay. So let us say that the two things that we have is upgrade or the new machine. So in each of the situation, I need to get the incremental cash flows. I simply need to get the incremental cash flows. Okay. So Now remember, the old machine is having a book value of 0, guys. So if the old machine is having a book value of 0, what can we essentially say about the old machine? You know, salvage value. Salvage value is 50. So of course, on that 50, I need to consider the gain also. Okay. So when we are deciding whether to upgrade or not this upgrade or going for a new machine, we need to also account for this 50,000 as an incremental cash inflow for us, right? Or the initial year, 0th year cash inflow needs to be considered. Okay. So let us say, first thing that we have is to look for what will be the uh, initial cash outflow if either of the two options is chosen. Okay. So we'll look at what will be the cash outflow in year 0. So first let us consider what is the cash outflow in year 0. So in year 0, what will be the cash outflow if machine is upgraded? So if we are upgrading the machine, what will be the cash outflow that we will have? Of course, it's going to be simply 10 lakh to upgrade the old existing machine. So if the machine is upgraded, the cash outflow is going to be 10 lakh. On the other hand, if new machine is installed, if new machine is installed, if a new machine is installed, then the cost is 20 lakh. Okay, so the cost is 20 lakhs. If the new machine is installed, we see that the cost is 20 lakh. Plus, I need to have an installation cost of 50,000, right? So let me just add 50,000 to it. And also, we are going to get 50,000 from the old machine. So I'm going to subtract that 50,000. But wait, this 50,000 which you're going to get is also going to be subjected to tax. And the tax rate is what, 40%? So the profit on sale of machine that you have, you need to pay 40% tax on that. So I just need to say plus on this 50,000, I need to pay 40% tax. So if this is the situation, what is the value of what will the cash outflow in year 0 if the new machine is installed? What is this number? So 20 lakh plus 50,000 minus 50,000. And to that you add 20,000. Yeah. So if the new machine is installed, then the cash outflow is 20 lakh 20,000. Okay. So that is done. Now, before we go for computing the cash flow after tax for old or the upgraded machine, I need to know what is the depreciation if the machine is upgraded and what will be the depreciation if the new machine is installed. Right? So, first up, depreciation. Depreciation in case machine is upgraded. If the machine is upgraded, then what will be the depreciation amount? Of course, that will be 10 lakh, right? 10 lakh divided by 5. So every year you're going to claim 2 lakh. And then secondly, what will be the depreciation in case new machine is purchased? Then there we say that it is 20 lakh 50,000 divided by 5, because 20 lakh plus 50,000 installation cost So that's going to be 4,10,000. So this is the amount of depreciation that we can claim if the machine is upgraded or if the machine is a new one. Right. So we are now going to compare the incremental CFAT. Right. So incremental CFAT. And then we will go for, of course, calculating the present values. So incremental CFAT, if the machine is upgraded. So let us say we have here old machine profit after tax. So we have here 1, 2, 3, 4, 5. 5 years. Old machine profit after taxes 5 lakh, 5 lakh 40, 5 lakh 80. So this is 5 lakh, 5 lakh 40, 5 lakh 80, 6 lakh 20, and 6 lakh 60,000. So that's your old machine profit after tax. Old machine profit after tax. Now let us first discuss about only the upgraded machine. Right? So upgraded profit after tax. So we're looking for only the upgraded machine as of now. So upgraded machine is, we're going to have the profit after tax for the upgraded machine. So profit after tax for the upgraded machine is 5,50,000, 5,90,000, 6,10,000, 6,50,000, and 7 lakh. So since we have the old PAT and the new PAT, I can get incremental PAT or the extra PAT that we have. Incremental PAT or extra PAT. So this is what, 50,000. In the next year, incremental PAT is again 50,000. Right? And then we have incremental PAT over here is what, 30,000. This is 30, and this one is 40. So incremental PAT are these numbers. And then after we have got the incremental PAT, I just need to add back the depreciation. Now the depreciation in case of upgraded machine, I cannot take the incremental because there's no depreciation on the old equipment. So the depreciation that we have is 2 lakh. Okay. And then we say, what is the incremental CFAT? Incremental cash flow after tax. So incremental cash flow after tax is simply the incremental PAT. Right? So incremental PAT, add to it the depreciation. So it is 50,000 plus 2 lakh. So the incremental cash flow after tax is 2,50,000 in the first year, 2,50,000 in the second year, 2,30,000 in the third year, 2,30,000 again in the fourth year, and 2,40,000 in the fifth year. These are your incremental cash flow after tax numbers. Okay, so these are your incremental cash flow after tax. Okay, and this is applicable for upgraded machine. Same way, we are going to get even for the new machine, right? So we'll do the same calculation even for the new machine. So in the new machine, as we say, in the new machine, we will say what is our existing CFAT, and then, what is the existing profit after tax, And then we simply look at what is the new machine cash flow after tax. So in case of new machine, we have here 1, 2, 3, 4, 5. You have profit after tax of the new machine. So profit after tax of new machine is given as what? 6 lakh, 6 lakh 40, 6 lakh 90, 7 lakh 40, and 8 lakh. Okay. Of course, to that, we are going to add back the depreciation. Now, what's the depreciation on the new machine? It is 4 lakh 10,000. So depreciation on the new machine is 4 lakh 10,000. Right. And then we get the CFAT. Now, of course, since we have the PAT, I can get the CFAT by simply adding the depreciation to my profit after tax. So this is going to be what? 10 lakh 10,000, 10 lakh 50,000. Then we have this as what? 11 lakh, 11 lakh 50, and 12 lakh 10,000. Now, of course, this is not what I'm going to discount. I will be definitely looking at the incremental CFAT. What's the incremental CFAT? Incremental CFAT. Incremental CFAT will be, of course, in comparison to your old profit after tax or old CFAT, just 5 lakh. So 10 lakh 10 minus 5 lakh 10. That will be 5 lakh 10,000. Then we 10 lakh 50 minus 5 lakh 40. 10 lakh 50 minus 5 lakh 40, which is again 5 lakh 10,000. And then 11 lakh minus 5 lakh 80, which is 5 lakh 20,000. 10 lakh 50 minus 6 lakh 50, which is 5 lakh 30,000. And 12 lakh 10 minus 6 lakh 60. So that is, yeah, 5 lakh 50,000. So this gives us the incremental CFAT. Now, obviously, we have to calculate the NPV. So simply we'll say calculation of NPV. Calculation of NPV. So we have two situations. One is upgraded machine, and the second is going to be for the new machine. For the upgraded machine and for the new machine. So we just start with the years. So year 0, 1, 2, 3, 4, 5. So this is going to be like your initial investment. And then in the 5 years, you have the incremental CFAT. Incremental CFAT. So let's write down the cash flow and then the PV. Cash flow and the PV. So of course, you can first write down the PV factors also. Okay. So upgraded machine, initial investment, if the machine is upgraded, initial investment is minus 10 lakh. Okay. And the respective year cash flows or incremental CFAT, which we have over here, it is 2 lakh, 2 lakh 50, 2 lakh, 2 lakh 50,000, 2 lakh 30, 2 lakh 30, and 2 lakh 40. Two lakh 30, 2 lakh 30, and 2 lakh 40. And then the new machine, we can say it is initial investment is 20 lakh 20,000. Initial investment was 20 lakh 20,000. So this is minus 20 lakh 20,000. And then every year we have 5 lakh 10, 5 lakh 10, 520, 5 lakh 30,000, and 5 lakh 50,000. Okay. So these are the cash flows that we have. Now from this, of course, we can calculate the NPV. And wherever we find that the NPV is highest, we'll be simply going ahead with that particular option. So if you find that NPV of upgraded machine is higher, we'll go with that. If the NPV of new machine is higher, then we'll go with that option. So just try to calculate the NPV guys for these both the options. Get the NPV or present value for both options. Yeah, get the NPV for both options. You can just multiply the PV factor. Well, the discount rate is given in the question. Discount rate is what? 15%. In fact, PV factors are also given to us. So you can take the PV factors as 1, 0.870, 0.756, 0.658, 0.572, and 0.497. Yeah. So just multiply them and get the present value as. Give me the present value. Give me the NPV. So this is the NPV for both options. Get the NPV. Yep. So the NPV numbers for the upgraded machine, it's going to be 1,91,000 minus it is 1,91,320. And for the new machine, it's going to be minus 2,72,070. So NPV in both of them, it is negative, guys. So what does it mean? It simply means that if NPV is negative in both the situations, the simple thing which we can make out from this is that both the options are not worthy enough. Both the options are not worthy enough. Rather, both of them are yielding in a negative NPV. So if both are having negative NPV, it's better to simply continue with the existing machine because the new machine or the upgraded machines are not giving you any sort of benefit. In fact, they are, eroding your NPV. Right? So of course, the conclusion will be to continue with the old machine and not to replace it with a new or neither to even upgrade it. Okay. Yeah. So now let us take one more question. Okay. Let us take this question 24. But this, yeah, let's look at this question number 24 now, guys. Question 24. So company X is forced to choose between two machines, A and B. The company is having two machines, A and B. The two machines are designed differently, but have identical capacity and do exactly the same job. So both the machines are designed differently, but they are going to have same capacity, and in fact, they're going to do exactly the same job. Machine A is costing 1,50,000 and it's going to last for 3 years. So machine A is costing 1,50,000 and it's going to last for 3 years. It costs 40,000 per year to run the machine. So the cost for running the machine is 40,000. Machine B, they're saying it's a economy model. Machine B is a economy model because it costs 1 lakh and it lasts for only 2 years. So it is going to last for only couple of years. Okay. And it's going to cost 60,000 to run. Of course, since it's an economical machine, it's going to even cost less for running it. These are real cash flows. So the costs are forecasted in rupee of constant purchasing power, ignoring the taxation. Opportunity cost of capital is 10%. Which machine should the company X buy? Now, which machine should the company buy? That ultimately is going to be decided by the net effect. Okay. So that net effect is something that we need to calculate over here. So now how do we go about dealing with the net effect? Okay. So when it comes to this, remember both the machines are having different useful life. And how we deal with the situations when two machines are having different useful life. So if machines are having different useful life, how are we going to deal with it? I cannot simply calculate NPV and take a call, right? I cannot simply calculate NPV and take a call because there we see if we are just looking at NPV and taking call, it will not be appropriate because one of the NPV will be for what, 3 years, another will be for 2 years. So how do we decide then? We know we decide it by using something called as a equivalent or annualized NPV, right? So that's what we are going to do over here. Okay. So let's say let's evaluate both the machines, or let's say one by one. So for machine A and for machine B, we first have the purchase cost. So for machine A, the cost is 1,50,000, and for machine B, the cost is 1 lakh. Life of machine A is having a life of 3 years, B is having a life of 2 years. The question is providing us with the running cost of machine. So running cost of machine per year. So running cost of machine per year, it's 40,000 and 60,000. Okay. So machine A is having a running cost of 40, machine B is having a running cost of 60,000. Okay. So let us simply say what is the present value of running the machine, right? So we'll say present value of running cost. So present value of running cost. Do we have the present value annuity factor given to us? No, the question is not giving us. So present value of running cost will be 40,000 into present value annuity factor at the rate of 10%, right? 10% for 3 years. And on the other side, you have 60,000 into present value annuity factor at 10% for 3 years. So present value of this is what 2.486. Okay, so 2.486 into 40,000. 2.486 into 40,000, which is 99,440. And then this is 60,000 into 2.486, which is 1,49,160. 60,000 into 2.486. Or wait, no, this will be for 2 years only. So for 2 years, the present value annuity factor will be 1.735. So 1.735 multiplied by 60,000, which is 1,04,100. Right? So that's the present value of running cost. We add to it the purchase cost. Purchase cost is 1,50,000 and this is 1 lakh. So when we add both of them, then we say what is the cash outflow of machine. So this is 2,49,440. And when it comes to B, it is 2,04,100. Right? So we are going to divide it by present value annuity factor, which was 1.735 over here, and here it was 2.486. So we get equivalent annualized present value of outflows. So 2,49,440 divided by 2.486. So that's 1,338. And in the second case, it is 2,04,100 divided by 1.735, which is 1,17,637. Of course, machine A should be preferred because it is providing us with a greater degree of annualized outflows. So greater benefits, I mean, say lower annualized outflows are in this case. Okay. So that is this question number 24, which was sort of very simple because we were supposed to be just calculating the annualized NPV or annualized present value. That's it. Okay. Now, the next aspect, let me just quickly answer this part. Decide when to replace the equipment. Right? So that is what we are going to look at now. Just a quick thing about it. So how do we decide when we should replace the equipment? So deciding the timing or frequency equivalent annual cost. Year 1, 2, 3. So if replacement is done every year, then we say that the NPV is negative 3 lakh. If the replacement is done every 2 years, then the NPV is minus 5 lakh 50,000. Then this is minus 7 lakh 80,000. So present value annuity factor is 0.909. Then it is 1.735 because it's a 3 year, and then we have this as 2.486. I'm talking this from the 10% perspective. So now I can get the equivalent annual cost. So it is 3 lakh divided by 0.909, which is 3 lakh 30,033. Then 5 lakh 50,000 divided by 1.735, which is 3 lakh 17,002. And then we have 7 lakh 80,000 divided by 2.406. That is 3 lakh 24,190. Now, of course, out of these three, you can definitely say that this 3,17,002 is the equivalent annual cost, which is the lowest. So that suggests us like the company should be replacing the equipment every 2 years, because that is causing us to have the annual cost as the lowest figure. Okay, so we need to look into these different categories, different types of investments, different time period for which the machine can be replaced. And for each of that replacement cycle, for each of those or each of that replacement cycle, we need to get the equivalent annual cost. And wherever we find that the equivalent annual cost is the lowest, we are going to say that it is going to be the one that we are going to choose, which is every 2 years. So we are going to replace the equipment every 2 years because that's going to give us the annual cost to be the lowest one. Okay, so in that, it may be like we have just taken, for example, 3 years. We may have even 4 years or 5 years. Everywhere we are going to apply the same rule that the equivalent annual cost should be the lowest. So wherever you find the equivalent annual cost to be the lowest, that is the replacement cycle, which is typically suggested by this method. Okay, fine, guys. Now, so that completes our NPV replacement. We'll be doing replacement decisions, but we'll be doing a couple of questions on this replacement decisions in our next session, because due to the paucity of the time, I may not be able to take up a full-fledged question for this, but we'll be definitely taking up that question in the next session. So right now, we have covered in our today's session, we have discussed about the more details about standard deviation and the variance. Especially, we were more learning about how to compute the probability if it's a dependent or an independent situation. So if it's a dependent situation, as I said, probability needs to be considered in the first year, and in the subsequent years, the probability is just 1, because since it is dependent, you know that now in the second year, in the third year, the worst situation is going to be there. Whereas if it is independent, then you just keep on multiplying the probabilities. And then we discussed about certainty equivalent and the risk-adjusted discount rate, wherein we said that if it is a certainty equivalent, if you're using certainty equivalent, that is obviously for the cash flows which are sure or certain. And those sure or certain cash flows needs to be discounted using risk-free rate. Whereas if you want to discount your expected cash flows, you need to get a risk-adjusted discount rate. So risk-adjusted discount rate will be obviously calculated by adding risk premium to the risk-free rate. And what will be the risk premium? So risk premium will depend ultimately on the risk that you are undertaking. Then we have sensitivity analysis. So in sensitivity analysis, we are going to have like a base case NPV, and then we are going to make adverse changes in the input and check for the changes in the output, which is NPV. Wherever we see that the NPV output is very high or the sensitivity is high, we are going to be careful of that particular variable. I've also seen the scenario. And then finally, we discussed about the replacement under two things. One is replacing an old equipment with a new one and deciding when to replace an equipment. Okay. So I think, yeah, we are towards the end of our today's session. If you have any queries, you can just highlight it, guys. Okay, I think there are no queries, guys.
Okay, I think there are no queries, and because you have explained all the topic, all the points in such a exhaustive and we can say transparent manner that nothing has been, no doubt has been left, and especially when you have explained that uh, dependent probability and independent probability, it is very clear, crystal clear. Okay, so I think the student does not have an answer. Student, with this, we are almost come to the closer of the topic of the capital budgeting decision. Uh, um, there is one student is asking for make me co-host, TS something. Texaket. Okay. So I think with this we have come to the almost closer to the topic of advanced capital budgeting decision. Only one session has been left, and I think Jagbandhu sir, it will be over in the next class. Yes. So it will be over in the next class, and we have and sir has taken many problems for the same topic, and it is one of the very important topic from examination point of view as well. Normally, either the question in the form of case scenario or a descriptive form usually come in the examination. So, sir, as a customary, just share our contact number for any concern of the student, because what are the concerns of the student? Yes, so student, this is our contact number 0120 3045 956. If you have any query, you can discuss me over the telephone, or otherwise you can also send you the mail, because in the previous last week we have received the mail on the same ID, and it is a very, and we have replied the same. So it is one of the very good practice from the side of the students that they want to get clear. So of course they can write us that email, but sometime email, if they're taking the time or they could not explain the way they want to explain their query, so even they can contact us over the telephone as well. And our email ID is sfm-final@ica.in. So student, thank you for patient listening and be interactive in the session. And thank you, Jagmandu sir, for sparing your precious time and letting the student on this important topic. Thank you very much. There is one student, Kasak. Do you have any query, beta? Okay. Okay, student. Thank you very much. Once again, thank you. Have a nice day. Yes, you can end.